Good afternoon, everybody. We'll get started here in just one more minute. Appreciate you hanging out with me. Good afternoon, William. Good afternoon, Carl, Larry, Don, Aziz. Good afternoon, Jason. Good afternoon, Marianne. Good afternoon, MZ. All right. Hey, let's get started. First things first. Required government disclaimers before we start the webinar. Please be advised that you should never trade with money you can't afford to lose, whether it's with futures, forex, equities, options, anything that you do that involves trading of any sort. Please familiarize yourselves with the risks. While above average earnings are possible, above average risks and losses are equally possible as well. Every effort has been made to accurately represent this product and its potential. However, this and every other webinar that you go to, you should remember there is no guarantee that you'll earn any money using any of the techniques, ideas, or products represented during this webinar or on our website. Examples are not to be interpreted as a promise or a guarantee of earnings. Also, hypothetical or simulated performance results do have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. They benefit from certain things like hindsight. Okay, keep that in mind. In addition to that, any news, research, opinion, analyses, prices, or information contained during the webinar or on the website is for educational and research purposes only. It's general market commentary and doesn't constitute investment advice or a solicitation to buy or sell any foreign exchange, futures, contract, equities, stock, any type of financial instrument. It doesn't take into account your personal circumstances. We don't know you. We don't know your particular details, so please don't trade or invest based solely on this information. You should also keep in mind that we do not hold ourselves out to be commodity trading advisors. We are not representing ourselves as professional traders that you should follow and do everything we say and do. Given that representation, all information and material provided today or during any of our webinars is for educational purposes only and should not be considered specific investment advice. Remember, trading is inherently risky and you can lose all or more of your principal investment. Thank you. We are here because the game is rigged. My name is Michael Leidick. I have been doing what I do now, which is unraveling a giant ball of knots, a financial game of hide and go seek, re-engineering, reverse engineering a puzzle, a seemingly unsolvable puzzle, now going on 10 years. We have over 4,000 customers in every major financial market of the world. We've been in business going on 10 decades in May, and it's a privilege and an honor to be here with you today. Just some basic guidelines and some rules. Number one, we have 100% transparency policy, which means everything I'm showing you here today is based on information that I gave you in the past for today. There is no cherry picking. There is no signals that disappear and reappear. There is no repainting signals after the fact. Everything we're going to talk about today is based on something I gave you on Tuesday night. Number two, you have the right to ask any question respectfully, and I will answer truthfully to the best of my abilities and to the fullest of my knowledge and capabilities. So this is your webinar. It's not an ego trip for me. Number three, I attempt to be in all things educational. I believe if you teach someone what you know, if they want to be a part of what you're doing, then an exchange of currency can take place. But I don't want to sell to you today. So everything we do today will have an educational tinge to it. If you see me, sense me, fear me, watch me drifting into sales land, you have the right to correct the ship, make a note of that, and we'll, if we stray from that line of logic and reasoning, move back into the educational lane. So everybody good with that before we get started? Anything in addition to that you'd like to add? Again, this is your webinar, so I'm excited to be a part of it. So everything is based on this one premise. When I first heard about traders, I was an engineer, vice president of business development for a high-speed automated machinery company. I had achieved the top of my profession, all of my goals for myself. I was designing equipment for industrial sewing machines, apparel equipment, customized machinery, and I was at the top of my game. And one of my customers on a service call one time out checking on some equipment he had ordered the prior year, told me about the markets. And he told me in particular about this technique he was using based on Fibonacci levels. Never tell an engineer about something he doesn't thoroughly understand, because it was like crack. It was like cocaine. I wanted to understand what he was doing. What are Fibonacci levels? It sounded very scientific, but nearly 15 years after that conversation, I've learned one thing. One very important thing, one universally applicable thing. The markets are not fair. You are playing on an unlevel field, the implications of which are so profound. And the players involved, the people who move markets, are not honest, God-fearing people. The world of finance involves trillions and billions and millions of dollars moving into and out of little black electronic boxes every day, and nobody is watching. When they catch these people, over the course of 3 years in this one case with JP Morgan, they were fined over, I forget what the amount was, $7 billion in fines in just a few years. Well, over the course of the $7 billion in fines, the same investment bank made $21 billion in profits. So for every dollar they pay in getting caught money, they earn 3. What incentive do you think they have to play fair? Nearly every presidential cabinet is filled with Goldman Sachs representatives and former employees and executives. The lobbying money that's transferred to people it's insane. And so people go into trading believing that they're trading against other people just like them. Joe Smith believes he's trading against Barney Johnson, who believes he's trading against Susan Greenberg. And the reality is, every day you wake up, you are putting money into a game that you have a 90 to 95% chance of losing every time you push the button. If you had a 90 to 95% chance of being hit by a car and critically wounded today on your way to wherever you went, and you knew this, would you get in the car? No. So I'm here to answer a question. I'm not answering it as a professional trader. I'm not answering it as a certified trading advisor. I'm not answering it as a fund manager. I'm answering it as someone who looks at the world and tries to understand the patterns. Someone who connects the dots and the lines and the pieces of evidence together to see and understand how everything works. And what I've built for you today is unlike anything you've ever seen before. And many of you that are here today are customers as a result of what I've shown you in the past. We're answering the question, do institutional behavior patterns exist in the markets that you trade? And everyone who's gone out into the past to look for these patterns, who's spoken to traders, people who are actually making money doing it, have come away with the same conclusion. There is no random market theory. There is no, it just does what it does, and we're all a bunch of feathers floating in the wind, and some of us are lucky and some of us are unlucky. Jack Schwager, the author of The New Market Wizards, interviewed 36 professional traders, and when he was done, he walked away and concluded there's no way that the efficient market theory is right. There's no way that it's just random. And finally, Stephen Covey, author of the book The 7 Habits of Highly Successful People, has this to say, and I want to kind of use this as the benchmark of our webinar as we proceed, and this is the last PowerPoint we'll look at for a while. He said, we simply assume the way we see things is the way they really are, or the way they should be. Our attitudes and behaviors grow out of these assumptions. So many of you today are struggling learning how to trade. Many of you today are frustrated. You've been at this 4, 5, 6 years. You've been with half a dozen or more education companies that seem more intent on making you pay thousands of dollars more and more and more in a never-ending cyclone and siphon of money. It seems like everything and everyone you come into contact with knows that your desires to succeed are failing, and they're willing to throw you a life preserver for another $10,000. But you know that it's attainable because you've met people who are doing it. You know that it's attainable because you've heard stories. It's like a mirage. It's always out there. But you haven't come to grips with the fact. You haven't really understood the severity of the corruption in any market. I don't care if it's futures. I don't care if it's equities. I don't care if it's Forex or binary options or Bitcoin or Yahoo or whatever it is you're trying to trade. The game is rigged. There is no other conclusion. And so you have one decision to make, and I'm going to ask you to make that decision here in about an hour. You are going to have to play an immoral game to win the funds from the immoral people. You are going to have to fight using the weakness of your enemy or your opponent. You will never win. The odds of you winning are logarithmically, exponentially diminished if you think you can play fair. If you think your fancy looking indicators and your general market commentary and your advice from the brokerage and all of these things that you've put together in your little ethical toolbox are going to help you succeed. I can tell you after 10 years and 10,000 conversations, literally, I've spoken with close to 10,000 people who try to do what you're trying to do. And I can tell you with statistical certainty that the odds of you succeeding using that technique are slim to none. You will win using the enemy's timing. This is a centuries-old technique. You pattern the people you are trying to destroy. And in this sense, destroy means take money from. You will win if you pattern the behaviors of the people you are fighting against. How many of you remember, are old enough to remember Muhammad Ali? Anybody? Anybody remember Muhammad Ali? Have you ever heard the expression rope-a-dope? Muhammad Ali fought someone named George Foreman way back in the day. And you know what Ali learned about George Foreman? He had no stamina. He threw big punches as hard as he could all of the time. And he watched him fight over and over again. He watched the tapes. He reviewed the statistics. He reviewed the techniques and the tactics. And he knew that if he just let Foreman get tired, he could use his own technique against him. In essence, he didn't have to fight. All he had to do was put his arms up for 10 rounds or whatever it was. And when he was exhausted, then he fought. He used the enemy's patterns. He used his enemy's behaviors against him. So I want to show you today how we do that in the markets. I want to show you today how you can leverage that information in the markets that you trade. And I've prepared a 100% transparent way of proving to you that this exists and this works. It is impossible for me to fake these results. Okay, well, how do we do that? How do I prove to you that ghosts exist? How do I prove to you that Jesus walked the earth? Because those are on par with the miracle, or I should say the revelation of what I'm about to show you. It would be as easy for me to prove to you that the markets are corrupt as it is to prove that ghosts exist. Okay, well, how might we do that? If my thesis is correct, what's my thesis? Banks are using time to communicate corruption. How would I prove that to you? Well, for 10 years, I've been doing something very specific. For 10 years, on Tuesdays, I've been sending out information for the following Wednesday and Thursday. And that information arrives in people's inboxes, is deployed on the same web page link as it has been for almost a decade, in the form of an email and a histogram. So every Tuesday night, my software, the one I've created for you, deploys information in the future based on the George Foreman behavior patterns of the banks, based on this rope-a-dope technique that we spoke about. And in a second, we're going to look at what those forecasts, what those behavior patterns were estimated to be in the futures and Forex markets. Well, in this case, it was the futures market, but we'll look at some Forex too, because I've gotten a lot more requests for that. And what you're going to see, hopefully by the end of this, is that we found a way to show that you can pattern the enemy. We're going to come out of the review session here in a second, and we're going to ask the question. Basically, were the behavior patterns accurate or were they inaccurate? And I'm going to ask you, Marianne, I'm going to ask you, Carl, we're going to ask everyone who's here today, Mamie, Nigel, Ray, we're going to ask each other, were we blowing smoke up our butts this week? Or did we really find something special? Did we really find and intercept communications that we could leverage against the oppressors, financially speaking? Okay, everybody on board with that? Again, keeping in mind, I sent the forecasts out on Tuesday for Wednesday and Thursday. We're coming out at the end of the markets to see, did the forecasts work or did they fail? Are we able to intercept these communications between banks? So first thing we need to do is understand what was sent out. In an email on Tuesday, I sent out a link to a web page. The link to the web page came here. And if you look at the email, you'll see that in the corner of my screen, Google is telling you when I sent it out. We'll blow it up so you can see. According to Google's mail servers, 2 days ago, you received a mail to a link that would take you, when you clicked on the link, to this page. Here's the link. It's updated every Tuesday evening for Wednesday and Thursday. Okay. So in this magic trick, I sent the information out before Wednesday and Thursday. Okay? So Mike, it gets a little harder for me to skew things, right? It gets almost impossible now for me to worm my way out of this. Everybody with me so far? Okay. So I want you to think about it this way. Mr. Wagner, you've already purchased the software And I find you to be a very logical person, which I appreciate about you. Would you agree that the farther we get from the email, the farther we get from when I sent the email out, the harder it is to predict what may or may not happen? Marion, does that make sense? Leon? The farther away from the email we get, the harder it is to predict what might happen. Okay, so every week what I do is I tend to focus on the Thursdays stuff, closer to the afternoon. Because if we're able to show with any modicum of accuracy that we were able to know what might happen then, things get pretty scary, in fact. So let's take a look at a couple different markets and see what was predicted for those. First one, a lot of requests this week for gold. All right. This chart represents an intercepted communication. In World War II, I believe it was, the German forces were using a machine called Enigma. It was a code machine designed to encode communications between the German forces in the field. And in the screen grab here, you'll see there were a series of knobs, Chris, that the German forces would use and change these dials depending on the time of day or week. And Marianne, they would type their message out and read those numbers over the radio waves or send them in communications to one another. And unless you had the machine set to those dial values, you could never understand what they were trying to communicate to each other until the Western forces actually intercepted one of these machines and was able to decode the communications going back and forth. So this histogram represents an intercepted communication. This represents an intercepted communication. And it's communicating something to us. In essence, it's describing a series of pre-planned behavioral times, or rather times where, when asked to look for them, the computer discovered behavior patterns that shouldn't exist in a random market. That is to say, Ray, if the market is completely random, there should be no evidence of recurring behavior patterns. So think for yourself, when you wake up in the morning, you get up at a certain time every day, right? Within a few minutes, some of you. Well, the economists, professors in colleges would have you believe that banks aren't like that at all. The markets aren't like that at all. That you could wake up at 8 o'clock, you could wake up at 9 o'clock, 9:30, 12:30, 1 o'clock, 1:15, that everything is random. But when the computer looked in the past, it said, hey, watch for buying pressure at 7:20, 8:30, 9:10, 10:05, 11:40, and 3:45 Eastern Time. Moreover, it said, watch for selling pressure at 5:45, 8:05, 8:50, 9:45, 10:15, and 1:15. So any of the times that are above the zero line are times that the computer has found historically the banks are methodically communicating with each other and pushing price down. Make sense? Similarly, the times that are below the zero line, according to the computer, are, once it went out and looked for them, times where banks are systematically discovering opportunities to manipulate and choreograph pushed prices higher. Does that make sense? So far, so good. Okay. Now, there are 4 possibilities in terms of understanding what should happen when we arrive at these times based on general market theory. And I'm going to lay them out for you real quick, and we're going to give them 4 letters. Okay. Possibility number 1, uptrend, downtrend. Possibility number 2, uptrend, downtrend. So Ray, if we arrive at a buying pressure time in an uptrend, if we arrive at a buying pressure time in an uptrend, Ray, generally one of 2 things will happen. Number 1, the market will have arrived there, Ray, at the bottom of a pullback, or Ray, it will have arrived there at the end of a consolidation. And when we arrive at a buying pressure time in an uptrend, Marianne, what should we see? We should see an impulse move to the high side, right? Does that make sense, everybody? Chris, right? Now, the opposite of that, of course, would be a selling pressure signal in a downtrend. If we arrive at a time that was historically a selling pressure time in a downtrend, we should have arrived there one of 2 ways. Number 1, at the top of a retracement. Whoops. The market should have arrived there, Ray, at the top of a retracement, or Marianne, at the edge of a consolidation zone. So we either arrive there at a pullback or, whoops, at the edge of a consolidation zone, followed by what? Followed by a huge sell-off. Okay, so we'll draw that line there. So these are the optimal possibilities. Ray, when people ask me, what is the quickest way to earn my investment back in your software? I'm literally drawing them with crayons on my screen right here. So we're going to call this possibility A and possibility B. Okay, there's 2 more that are really quite simple. Number 1, if we have a selling pressure signal, a selling pressure signal in an uptrend, one of 2 things will happen. Number 1, we will have gotten there usually at the top of a pullback. And then Marianne, one of 2 things will happen. The market will go down with a small retracement, okay, we'll go ahead and put our circle here. Or, Ray, more likely than not, the market will go sideways. Oops, let me delete that. When you have a selling pressure signal in an uptrend, many times, Ray, the market will people will take profit here and will go sideways for a while. It'll stall as people take profit. The trend isn't over, it's paused. And then, Ray, more likely than not, we'll look for a breakout candle from there where the trend will resume. Does that make sense, everybody? When we have a selling pressure signal in an uptrend, or what we'll call our C example, price is rising, rising, rising. The banks come in and they're selling, taking profit, taking profit, taking profit, taking profit, taking profit. Anything left to take profit from? No, we're good from now. Let's keep going. Or they take a lot of profit and we get sort of a variant of the B. Ray, does that make sense? Gary on board? Okay, this is important. So I want to make sure we all understand. The opposite of that is the following. If we fall into a buying pressure time in a downtrend, the opposite will take place of our C example. And one of two things will happen. Number one, we could see a small retracement up. Or, more likely than not, we could see the market go into a consolidation phase where it goes sideways, and then, Marianne, a breakdown where the trend continues down. We'll call this possibility D. How confusing is this? Nigel, am I on board? Mamie, am I in a window of comprehension? Seems like 101 stuff, right? If it's not, please tell me and I'll explain it in more detail. Otherwise, let me know if I should move on. Move on. Okay, so when we arrive at these times, Marianne, we have a, what's the word I want to use? We have a translation technique, right? We have the Enigma machine dialed in. Tony, we understand what the banks are likely to do at these times. These are also areas, Gary, where stop runs are likely to occur. Okay? These are also areas, for example, Gary, over here, where we'll see stops below or stops above kick in. As a matter of fact, let's actually put the phrase stop run in both of these examples. The banks will trigger stops at A and B's. We'll see plunging candles and whatnot there. So let's take a look. These were the signals that the software gave us for gold on Tuesday, and here it is on Thursday. And you'll see here 720, 805. Now let me pull this up just so you know what we're looking at. Okay, 720, 805. Beautiful. Okay, so now if I pull this down, let's take a look at what happened in gold over the course of a day's worth of signals. Okay. So Marianne, down here are all the times, right, that we were watching today. And up here is what actually happened at those times. So here's the US session, the one everybody's been watching all day today. Gary, are you ready? We're just going to do a low-hanging fruit exercise. We were waiting for it to go down at 805, to go up at 835, to see selling pressure at 905, to see buying pressure at 945, and then Gary immediately reverse at 1050. We were looking for selling pressure at 1050 up until 1225, and then selling pressure at 1225. Gary, that was supposed to change coming into 210. And then start to reverse coming into 305, and then again at 340. Does that look like the bank was randomly pushing prices, or Melissa, does it look like there was something going on here that we intercepted something we weren't supposed to see. Let's take a look at another one. This one was fun today for me. I enjoyed this one a lot. NQ 916. There it is. Okay. So these are the forecasts for the NQ 0318 contract. If you're a Flux customer at home, I'm using a swing pivot strength of 8 for my analysis with a 714 look back. Today in the live room, these were the times that we were waiting for moves to happen. Remember, Gary, what I said the highest probability signals were, right? If it's a downtrend, what signals are we looking for? Everybody? What times were the optimal times based on a downtrend? And I'm using a 120 EMA in this case. A, B, C, or D. Okay, B or D, exactly. The highest probability signals are B. Okay. Based on that, Nathan, which times were we most interested in looking for signals that would move immediately in our direction with the biggest profit potential? Well, 816, 824, 840, 853, 904. Marianne, we have a candle close below the moving average at 947. The first candle that closes above the moving average after 947 is this guy. The next signal in the direction of the trend is 10 o'clock and then 10:14. In my class today, I had a signal at 10:31 using an advanced technique and then another one at 10:36. What's going on here? As we went into the afternoon, where the signals are farther and farther away from the forecasts, we'll see at 104, I had a signal for a possible long. At 125, I had a signal for a possible long. And then right here, Marianne, the signal crosses over after 133. 2 o'clock to 2:20 was the move we were looking for. 2:34 was the last one here, 2:56. These were the signals in the direction of the trend. Let's go take a look at the ES. That one was really interesting to me today. Okay, so far today, the signals that are farthest from my forecast, Chris, let's go after lunch today. I was looking for an up move in the ES at 105, a down move at 155, and then an up move at 355. Everybody see that? Looking for buying pressure at 105, selling pressure at 155, and then buying pressure at 355. Again, here's the forecast. 105, 155, 355. Sanjay says, does the look back change? Sanjay, every week since I introduced Time Warp, I've been using one setting for all markets. A 714 look back with an 8 swing strength. I haven't changed it since July. So that's July, August, September, October, November, December, January, February. Jason DJF. Before that, when I was selling the Flux, our other tool set that we sold for years before we migrated to the Warp, I would use a MACD, 520, and a power zone, 120, with a 2 max weeks look back. And Sanjay, I didn't change that for 9 years. So these values that we're using aren't changed. They're not optimized. It would be really easy, Sanjay, if you were me, to change the values each week to make it look really good, wouldn't it? Tehran, wouldn't it be really easy for me to change the values each week just to dial it in, maybe optimize it a little bit, round the corners off? Okay, but I can't, because then we lose that transparency. Marianne, all the markets I'm showing you today here have the same settings. 7, 14, 8. They're the same settings I sent you and your buddy last week for the Bund. They'll be the same next week too. So when we look at it in totality, Chris, here's the cool part. This is what I sent out to you in the email today. We were looking, if we went all the way back to the beginning of the London session, we were looking for longs using the technique that I set you up with at 3 a.m. Eastern, 8 a.m. London time. And at 3 a.m. Eastern time, 8 a.m. London time, Marianne, the market went up $2.50 ES, or $125 per contract. The next signal, Marianne, with the direction of the trend was a B signal from 410 until 430. And Sanjay, that was another 3 points where the market moved immediately in the direction of the forecasted signal, the intercepted communication. Okay, so now Marianne, in a downtrend, when we arrive at a buying pressure signal, the appropriate response as a trend trader is to wait for what? It's to wait for the breakdown. Wait for the breakout right here, right? Same thing I taught last week. Same thing I taught the week before. At 4:30, that kicks in. I use dots. I use the dots on my chart as lines in the sand. And you'd be well served to look for those breakdowns as well. And so if you were short at the breakdown of this dot, what I refer to as a puncture trade or a trend continuation setup, you'll see here, Sanjay, it actually made it down another $3 or another $150 per contract straight in the direction of the entry. If you're keeping track, that's $5.50, $8.50, or almost $500 per contract in a couple hours in the same 3 settings, 7, 14, 8. Now here's where things get really interesting. Marianne, look, at 6:30 this morning, the software had alerted us to what? Can everybody see it? This is on Tuesday. Let's not worry about when to get out, okay? Let's let the wine swirl around in our mouths for a second before we swallow it. Let's appreciate the bouquet and the miracle of what I'm showing you. I'm not telling you when to get in or when to get out. We're looking at what did the software say happened and what happened. Do you understand the difference? Because everybody trades differently. Some people will scalp it for 3 ticks with 10 contracts. Some people will hold it all day. 6:30, what was supposed to happen? And Marianne, how long was it supposed to last? How long did we have before buying came back in? 8:20. It's almost 2 hours. Okay. When did I send the email out? Two days ago. So it's 6:30. The candle closes, and Sanjay, be careful. There was a lot of heat on this trade, Steve. It went 2 ticks against you. And you held it for 2 hours, and it kept moving down, and it put in a lower low, and it put in a lower low, and it put in a lower low. And it went almost $9 in the direction the computer warned us about. Okay. We get to 8:20. 8:20 is a counter trend signal. What are we supposed to see when the market is in a downtrend? Well, that's D. Steve, when we get to a D, a buying pressure signal in a downtrend, we expect consolidation. Candles get smaller, market starts to consolidate, and then a breakdown. How do I define a breakdown? I define a breakdown as a push through the dot. Okay, now watch. It pushes through the dot right here. I enter short here. Marianne with a stop right above the puncture candle. And I'm going to lose. I took a bet on the trend continuing down, and I lose $3.25. 11:25, I lose again. I enter on the close of the candle. Steve, my stop is just above that dot right here, and I lose 3 again. 11:50 is the next time the software told me to look for an entry, enter at the close of the candle, and I get out by the opposite 2:15 candle right here for 3/4 of a point. I get to the 12:15 candle. It's lunchtime, nothing to do. 1:15, I can enter here, and my stop, Steve, is hit on the other side of that line. I lose 3.75 points. Here comes 1:55. It's a signal in the direction of the trend. The candle closed below the line. And now it just goes down and down and down and down. In fact, it went a total of 14 points down before finishing at the next signal, 7 points by the 1:55 signal right here. Can everybody see that we're just using 2 kinds of entries, breakouts and trend entries? Yep, if we held this one to the next signal, it would be break even. That's correct. You wouldn't have gained or lost anything. So now, what happens if we just used time as a way to enter and exit the market? Seemingly, if you read reviews about me, random times that have no bearing in reality, right? There's no way they could work. We have plus 2.5. We have plus 3.0. We have 0. We have plus 8.75. Okay, we'll keep going. We have minus 3.25. We have minus 3 plus 0.75 minus 3.75 plus 7. These are all times, signals based on time, right? So what's going on here? How is that possible? How do you net over $14 using nothing but time? Well, it's based on understanding when banks are going to move and when they're not going to move, right? This works on European markets as well as US markets, by the way. If we look at the DAX, for example, on the 3-minute chart using the signals that I sent out today, Marianne, your mentor, guru, friend trades the bund, but the DAX follows the bund very closely, right? Where would you have gotten short today? Where would you have gotten short? Anybody? Well, if the market was in a downtrend, the email that I sent to you on Tuesday said to look at 736 and 827 and 923. Okay, so if we look here, 736 is here. There's 827. Here's 939. Here's 12 o'clock. So in pursuit of profits here, we would have had a short entry in the DAX good for $14.50, trading time to time. We would have had an entry in the DAX worth $47.50 here. There was a stop out at the 939 signal at the open of $15. At 12 o'clock, if you held it to the opposite time, the signal was good for $32. Now, that doesn't count the breakouts. If you looked for a puncture of the white dot here, the consolidation is over, the trend resumes, you would be short until the next time, which is $96. Here you would have been short until the next time, which would have essentially been a net loss of $2.50. You would have been short here. It immediately moved in your direction to $33 before it came back and took out your trail stop, basically ending your day flat. And then at 3:45, you had an entry short right here using the same breakout rule, and you would be short another $30 with a stop out at 227 of $7.50. Okay, Nathan, we're just looking in very general terms today. Stop, start, move, stop moving. We're looking at it conceptually, right? The software had told us about these windows of time. And when we come back and look at what happened in those windows, what we were anticipating to happen based on a very simple Sesame Street crayon-driven interpretation that we taught last week and the week before that and now this week. Here's the question. In this very European market, 2 days after the computer generated the times, if you followed in their footsteps, did you have the same results that 95% of traders had? If we just looked at what the computer had found, were we on the right side more often than not? That is to say, at each of these arrow points, at each of these places, were we investing in a movement, Marianne, that produced a move in the direction we were waiting for? Sanjay, that's a brilliant question. Plus 15, plus 90, plus 50, minus 2, minus 15, break even, plus 32, plus 30, minus 8. Okay. Where would your buddy have gotten short today, Marianne? The one who didn't believe you last week. Here, 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 here. Also, here would have been a stop out, short here, and there was another short 11:30 this morning using the forecasts I gave him last week. That was for Monday, right? That would be the 29th through today. So Marianne, all the times I gave you as per your request resulted in this, 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 stop out, this, this, nothing, and that. So in the bund, that was from here to here, 45 from here to here, 68 from here to here, -5 here to here, stop out, -16 here to here, flat, here to here, stop out, here to here, 27 here to here, 44 here to here, -2, and then today it's still going, plus 43, 45, let's say 100, 125, 165, 200, 198, 178, 158, 153, 150 total, using the signals I sent him last week that he did not believe. You asked a really good question, Sanjay, and I want to go back to the DAX to hit on it. How do you know which of the breakouts might be fake outs? And how would you know when the signal is actually going to be a push back up? Well, I made an offer. So Sanjay, historically, I only show trend entries because of one very explicit reason. Of all the people that I've met, and this is very selfish of me, vendors, you should know, have ulterior motives in addition to building their software. Did you know vendors have ulterior motives? A lot of them are just very selfish people. The overwhelming majority, Sanjay, of traders, when you ask them the following question, are you profitable? Over 60% of the people that I've met identify what they do as trend trading. Okay. And so the unfortunate part of that is over here. When you look at what people market in their trading systems, they market everything, all of the selling that's done, all the systems people buy are usually counter trend. Their software can pick the high or pick the low. And that's very attractive to people. So in understanding how far will it move, there are a couple different ways to understand that. Okay. One of the first things you can do is you can deploy a mean reversion indicator. A mean reversion indicator. What is that? Well, have you ever heard, Sanjay, of a Keltner channel or a Bollinger Band? Something that looks like this? Okay. Well, the premise of a Keltner channel or a Bollinger Band is that the market will move from one extreme to the other and return to the mean or the average. Okay. So, for example, if you look at some of the counter trend signals here, in the same system that we're looking at, a trend signal this morning at 7:36, it looks like, Sanjay, tells us that we have a window from here to 7:54, all right, because the trend is down, and you understand that. Okay, well, how much room does the counter trend trade have to go? Well, let's explore it. And you already see the answer. You're pretty sharp. You come here each week. If we're watching this dot for a puncture, Sanjay, the first place that we could look to see before we expect a reversal is down in this area, is it not? That would sort of be a place to say we've moved too far from the average too quickly. We've moved too far too quickly. And so in the case of the DAX, that would have yielded a nearly $18 move. And I think it's how many euros per tick on the DAX? It's pretty monstrous. No country for old men. And so you can evaluate when you arrive at these signals. For example, the next one, Sanjay, was down here at 8:57. And so now at 8:57, you can sort of develop this counter trend strategy of, is this thing worth my time? Okay, if I go short at this line, all right, we'll draw the arrow. If I go for this puncture, my stop is here. I want to have at least a 1-to-1 risk reward on a counter trend trade. So if I'm willing to risk, Sanjay, this amount, I want to see the trade produce at least that, right, on the other side. So is there enough room between me and the lower band to achieve that? Yeah. Okay. Compare that to the signal at 10:15. And if we look at those same conditions at 10:15, Sanjay, now we have a statistically relevant mechanical way of identifying potential. And at 10:15, the first two signals qualify for a 1-to-1 RR, a 1-to-1 risk reward. But when we get to 10:15, you'll see that our risk is just above this candle right here. Okay, so now we have a small rectangle, but on the other side, there's not a lot of room for this thing to run. In fact, if we move it down, it's farther than the green line. This trade actually ended up working. But in terms of understanding how much room does this have to move, there's really not a lot of space. Okay, so you can identify potential movements using a mean reversion system as one way to understand how far it has potentially to go. Does that make sense? Okay. So everything kind of hinges on, again, the information is here. I do not, Sanjay, no, I don't. I'm so immersed in the timing part of it that I don't need anything but the time signals. And I'm trying to teach people more and more to rely on the timing signals as often as I can, because there's a wealth of information there. Okay, so this next example, we're kind of coming up on an hour here together. Again, we'll get rid of this. We see that crude was in an uptrend for 95% of the day, right? Crude was in an uptrend for 95% of the day. We have a 3-minute chart here. We'll go all the way back to the Euro Open. And so now, using our Bert and Ernie, Sesame Street, Kermit the Frog interpretation, it would appear that we can use either this or this for entries. Ted, does that make sense? Tehran, does that make sense? Michael? William? That's all right, brother. Pat, it was good to see you. Aloha, man. That means goodbye and hello in Hawaiian. So Bjorn, if the market's in an uptrend, we're going to give more consideration to the buying pressure signals. So this one right here is going to dominate. I could use some nice weather. So Pat, any signal in the direction of the trend, this is going to be the one we want to look for, right? So Marian, let's look for all the signals that we can find in the direction of the trend based on what we sent out a couple days ago, right? So again, 851, 851, 939, 939, everything matches what I sent out 2 days ago. Here we go. First signal is 339. That's 8:39 London time. Frank, my swing strength is set to 8. My day search 1 is 7. My day search 2 is 14. Swing strength is set to 8. Here's all my settings. Okay. Gary, what happened if we went long at 9:39 and held it to the next signal? Did we catch the banks with their hands in the cookie jar? 17 ticks worth. Okay. I hate asking rhetorical questions at webinars. You see what happened. 4:45, the banks opened up the vault. 16 ticks. 6:30, we have a very small window. And we finish right where we started. We lose 4. 6:57, Gary, here it comes. There's 7. So we've had 1, 2, 3, 4. Here comes 5. And we're patiently waiting. I've been waiting for a trade like you to come into my life. I've been waiting for a trade like you. Plus 10. When's the next window? 9:39. But it's 8:51. What do I do from 8:51 to 9:39? Make a sandwich, clean your room, wash the dishes in the sink before your wife comes home. You know better. 9:39 comes. I've been waiting for a girl like you. Plus 12. Done. Next signal's coming, Melissa. Here it's coming. She'll be coming round the mountain when she comes. Stop. Damn it! How much did we lose? 9. Bum, 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 bum. Okay. Same thing happens at 11:03. Womp, womp, womp. Minus 5. 11:21 is a signal with trend. See what we're doing here, guys? Ladies and gentlemen. 3 in a row. Hits the stop. Boom. Minus 16. Aw, crying over you. Okay. What are we going to do? Return the system. Melissa, we're going to write a bad review on Futures.io. We're going to call the SEC. We're going to submit a screenshot to tradingschools.org. Fraud! Nope. You wait for the next signal. You wait. Next signal, Marianne, is at 11:48. Comes within 1 tick of the stop, and it finishes. Can you take me high enough? 20 ticks. Next signal comes, small stop. Look. Minus 6. Here comes the next one, 121. Finish where you start. When's the next train leave the station, Billy? What does the bus schedule say? Next train leaves the station at 2:42. Plus 30, plus 21. Forgive me. I got a little reactionary there. 3:45, if you're still trading, you finish with a small loss of minus 3. No, Larry, we don't sell automated software. However, you can hire a programmer to automate this strategy for you. Assume the liability of that, and you would have seen the same results you saw here today. All of the indicators are open and available to be called by a strategy. Okay, you want to add it up? Using the signals that I sent out 2 days ago to 18,000 people. Here we go. Ready? And I'm going to round the numbers down when I don't know or I can't read. 17 plus 15 plus 7 plus 10 plus 12 plus 20 plus 0 plus 21 minus 3 minus 6 minus 16 minus 9 minus 4. Can you see what that net result was, hypothetically speaking, from the UK to the US session? $10 a tick per contract is $640. Okay, let's take off commissions. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 times 20 is what? 280. So let's say 640 minus 280 is $360 per contract net. If we go back and look at the original file, Marianne, we would say, Donald, we were looking at the answer to this question. Are banks using time to communicate their corruption to each other? Are banks using time to communicate their corruption to each other? When we look at the signals and we look at what happened at these times, is the answer to that question yes or no? Did I meet the required burden of proof? Or am I like every other vendor out there, looking for traders who are clinging to the last branch on the way down, selling hope and dreams and fancy indicators that don't do much of anything but repaint, disappear, reappear, optimize the settings every week, the settings change? What's going on here? If we look at other markets, for example, the pound dollar on a 15-minute time frame, we'll see that we have access to equally compelling signals. Now, in this setting, you should know that I've doubled the swing strength, Larry. Gary, I don't work at a bank. I don't know. I know that there are people that used to work for banks that left and bought my software saying it was like what they were using at the bank. So I have customers that left working for investment banks who said that they needed my software to complete what they had when they were there. That's as close as I've gotten to it. I also have a customer who traded energy for an electric company, and he said in the meetings he attended with the investment traders that they focused on times in the meeting as well. So I have 2 or 3 stories, little peeks into that universe. When we look at the pound dollar, I'm looking at a 15 swing strength on my pivot, and we see those kinds of signals as well. We have this 645 signal, the 1800 signal, the stop out at 3 a.m., the good signal here at 8:15, the good signal at 6 o'clock, 245 2 days ago, and now we have the one here at 3 o'clock today. And in each of those cases, we're seeing the same kinds of behavior patterns, right, Marianne? Stop. We're moving up in the anticipated directions at these times. And so, Gary, as we look forward into the future, do you see what's sitting here on the right? These are test times. These are times in the future, Gary, where we may see what? Another one of these, right? There are 2 kinds of customers that come to webinars like this. And they ask 2 kinds of questions. And Gary, I don't pretend to know you, but I know generally after 10 years of doing this what to expect. There's the customer that asks what, and then there's the customer that asks why and how. So questions are, what are the signals? What is the accuracy? What is a way to trade? Etc. and so forth. Then the other questions are usually asked by people who ask, why do they do it? How do they do it? Okay. The questions on the left can't help you trade. The questions on the right can help you trade. These are philosophy questions. Okay. These are trading questions. Okay. So when someone asks, how do you know this is the banks? Gary, could I have made the market go up or down at these gold times today? If everybody in this room, all 63 of us, bought and sold at these right times, could we make the market go up or down in gold? Could we have done what we did in crude? There's no way. We don't have that power. We're not financially liquid enough. Some of you are. Earl, you could have burned this place down today. Hey, Earl, how are you, man? It's good to see you, brother. Those of you that don't know Earl, don't mess with him. There's a lot of acres in the Everglades. So Gary, I'm assuming that institutions are moving these. And I have other proof that I can show you if you're a customer. Email me if you're a customer and I can tell you some things about how I know the banks are doing this. Okay. So I've got that. And Gary, how does any cartel do anything, right? How does any cartel do anything and get away with it? Okay, that's the thing. That's the thing. I'm less interested in the how, and I'm more interested in the what. I'm less interested in the how. I'm more interested in the what. All right. So I took a look at another instrument here, the Eurodollar, and I want you to see that the same information is available, right, on a 60-minute time frame. The next signal I have here is 5 a.m. tomorrow morning, and then 3 a.m. after that on Monday morning of next week. So Marianne, on Monday morning of next week, there's a chance we might see another one of these, another one of these, another one of these, another one of these, or another one of these. That could happen, Gary, here. Now that it's possible to know that, it sort of transforms trading a little, doesn't it? It's weird having stuff on the right-hand side of the chart. It's weird having stuff on the right-hand side of the chart. Right? So Marianne, your buddy, Gunter Guru, you see what's waiting tomorrow at 9 a.m.? The same thing that was waiting here, the same thing that was waiting here, the same thing that was waiting here, and here. And look at what just happened here. So Teep asked a really good question. He said, what time frame is best to use? Now, the majority of most vendors tell you what time frame or sized bar to use. In my experience, again, 10 years doing this, 10,000 people that I've spoken to, about 1,000 people a year, I have learned the right time frame is the one the customer feels comfortable in. Let's take a quick survey. Ready? And I'm going to let the customers answer this question, and I want you to be part of it, Teep, okay? How many of you trade between a 1 minute and a 5 minute time frame? How many of you trade between a 5 minute and a 15 minute time frame? And how many of you trade between a 15 and a daily? We're going to call this A. We'll call this B. We'll call this C. Okay, I need 10 people to answer that, and I'll show you what the screenshot says. One, two, three, four, five, 6, 7, 8, 9, 10. Okay. Everybody's excited about this. All right. So Teep, I want you to see this. And everybody, pay attention to this. This is important. So Teep, if I told people that they could only use my system on a 1 minute time frame, how many people Don trades a 600 tick, which is closer to a 3 or a 5. How many people, Don, do I immediately preclude? I can't work with Nathan. He's on a 32nd. God bless him. I can't work with Maria. I can't work with Don. I can't work with Wes. And Jason. So almost 1/2 of the people, 1/3 to 1/2 of the people that are looking at the software won't do what the other 1/2 of people are using. Okay. What I find, here's the answer to my question. Here's the answer to your question. Most people have an intellectual knowledge of the time signals. That is to say, they know in their head how it works. So Melissa, I was playing basketball with my son's basketball team. He's 12, by the way. And Teep, I sat in the stadium cheering for his team forever and ever and ever, all through these years. And Melissa, I was screaming at them when they were shooting and taking shots. I was telling them what they should do and who they should block and who they should pass to. And Teep, I went out there after their last game just to horse around, just to play with them a little bit and show them, quote unquote, how to do it. And I couldn't get it I couldn't even reach the basket they were shooting at. These are 12-year-olds. I missed the basket. In my head, I knew how to do it, but physically, I had no experience with it. So Teep, what I recommend is you start out on the smallest time frame you are comfortable with. The smallest time frame you're comfortable with. And in the webinars, I show a 1 minute. So over the course of a US session on a 1 minute chart, you're going to see about 30 signals a day, but you're going to see them live. And Melissa, that's like practicing a basketball shot, right? That's a free throw that you actually physically take. And then what happens, Teep, is over time, people start to graduate to the time frame that they feel comfortable with, because there is a personalized element. It's yours. I know people who trade the euro Japanese yen on a 15-minute chart, and if you ask them to change anything, they'll have a heart attack. They'll have a coronary. They'll pass out. Don't ask me to do that. So if we're looking at FGBL, for example, and you're on a 10-minute chart and that's your thing, Teep, did you see the accuracy of the signals change that much when I changed the time frame? Or does it just look like smaller pieces of the same piece of big cheese? It looks like a leaf from the big tree, right? Time is fractal. We can break it into smaller pieces. There are smaller patterns inside of the bigger patterns. There are smaller patterns inside of the smaller patterns where we can go all the way down to a 1 minute to a 30-second. I have customers using this hand to God on a 15-second chart. I don't understand it. Marianne asks the question, what happens if you combine time frames? Okay. Higher time frame analysis. I have found, for me personally, that higher time frame analysis is a method some vendors deploy to keep customers off balance because it can't be easily mechanized or standardized. So in that sense, Marianne, the question is usually, I'll have a customer who I'll say, what time frames do you look at? And I giggle when these customers come, and it's not a sign of disrespect. It's just I've seen it so many times. Michael, I look at the weekly chart, the daily chart, the 4-hour, the 1 hour, and the 15-minute chart, and then I trade signals off the 5-minute chart. But here's the thing. The weekly is up, the daily is up, the 4-hour is down, the 1 hour is down, the 15-minute is flat. Nathan, does he still show the 3-minute live in his room? Does he show my stuff live in his room? Okay. Sweet. Thanks, ma'am. So what I find for me personally, and this is just me personally, I'll reference 2 time frames. And generally for me on an intraday time frame, I'll look at the hourly and then a 1 or a 3. I'll look at the hourly and then a 1 or a 3. That's the closest I can get personally to identifying 2 time frames. So let's actually come out here and take a look. So we'll go back out and look at the ES, for example, the US index. And then Marianne, watch, I'm going to go out to a 60. Okay. So here's the 60 on the ES. And so the market now, Marianne, is broken into these windows. Do you see what I mean by that? So if I reference higher time frames at all, which I don't, me personally, I just look at the smallest time frame. So these are windows where I'm looking for chop or downward movements, and then Marianne on a lower time frame, I'm looking for trend moves. These are windows where I'm looking for chop or down moves. These are windows where I'm looking for a trending movement. Marianne, if it comes below the white line, I'm looking for chop or down moves. Here on the higher time frame, I'm looking for chop or down moves. Here I'm looking for up moves, and for a little while, chop or down moves. I'm looking for down moves. Here I'm looking for down moves or chop, and then up moves on my lower time frame. You see how that works? The 1 hour chart can help me understand what signals to look for. So this morning, for example, from yesterday till now, from starting at 11 o'clock this morning, from 11 forward until 3 o'clock, I had a window where I was looking for movements up. So 11 o'clock forward. And now down here, let's go to a 3-minute chart, I guess. Starting at 11 o'clock, I'm looking for long signals, right? So Marianne, the first signal that I see after 11 o'clock, here's 10:51, where the trend should start to go back up, right? Where we just drew those arrows here. The first place, I don't see a candle close above the moving average until the 11:33 signal. So when we have a signal in an uptrend that is a counter trend signal, Marianne, the rule that we deployed was what? A breakout of the dot, right? So the first place I had permission with the higher time frames consent was to go long right here. Where's my stop? Right below the puncture candle. Do you see how that works? The first time on my lower time frame where I'm supposed to see any kind of selling pressure again is 12:27. So if I leverage the higher time frame, I get in, it goes against me 3 ticks, it goes for me a total of $8 before that first selling pressure signal. That's how I would deploy. But everything to the left of the 11 o'clock signal, according to my higher time frame, I'm expecting chop or down moves, right? Chop or down moves. Teep, I don't have to look at the 2 time frames. I don't look at the 2 time frames. The question was asked, how would you look at 2 time frames if you did? Remember, no 2 people in here are alike. Everyone comes with their own bias and their learning and the techniques that they're using. So when I'm looking at the higher time frames for customers who look at higher time frames, this is the way that I look at it, that I found has worked well for me over time. There is no right way or wrong way. Okay. Any questions? How do I get it? Okay. Are we all okay with the how do I get it question being answered now? Was that salesy at all, or did I stick to the educational part of all this? Okay. When we first started, here comes the pitch. So customers, if you already have the software, here comes the pitch. Every week, no other vendor does this in any ecosystem, in any environment, in any trading platform. Every week, I send an email out on Tuesday with the forecast times, the behavioral patterns for the banks on Wednesday and Thursday. Every week we finish at the end of the seminar and I ask the question, did the forecast times work? Is there anyone here who says no, they did not? Yes, Frank. Okay. That bears one additional question. And I ask the same question every week. And some of you come every week like, you've never seen this before, or you're mystified, or I talked to my friend and he said, there's no way this can work. Okay. If you know it's possible to have these times in advance, why wouldn't you have them? Ben, you've been to so many of these webinars. I've lost track, brother. You're here every week. You hear the same things week after week after week after week after week. You see the same things. We start to call customers who come back and forth all the time mascots. They show up for the game and then they go home. Every day, 90 to 95% of people who attempt to trade are in the wrong side of the trade because that was the plan. Based on the times of day the markets were going to be pushed up and down. Okay. Again, when we started, I was very clear. And you know this is true. Call any brokerage and they'll tell you most of the money they spend is getting new customers. Because at the end of the month, the people who were successful are here and the people who failed are there. It's impossible statistically for 90% of people to be wrong on the trade every time.